Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin. So how are you today, Martin?
Yeah, pretty good. It's very cold here. We've definitely got some winter at the moment.
It's pretty cold down in Tassie as well, and there's so much to get through. I feel like these episodes just go so quickly, even though we try to keep them 4 weeks apart. But there's so much happening around the world, a lot in Australia as well in terms of the property market. Now we've got
Yeah.
Victoria, COVID lockdown. So any sort of zooming out views before we get into the details, Martin?
Well, I think it's worth reflecting on what the World Economic Forum and the IMF has been saying about the risks of a second wave and the broader implications with regard to economic performance globally. And, they're now warning very seriously about the fact that this is not going to be V-shaped. This is going to be long, and it's going to be tortuous, and it's going to be 2 or 3 years before things are back to where they were. I think that's important context, right, for everything that we talk about, because there are still people in Australia who are talking about V bounce back. No, nothing to see here. It's all over. Unfortunately, I don't think it is all over, and I think that wherever you look, you can see signs of more distress ahead.
Yeah, and I guess that was probably one of my messages, that I just fear that people won't take it seriously, or the countries where there's that hubris. We've seen it in all these states in the US, but maybe also in Australia recently. We see the nightclubs with all the kids. I don't think that's necessarily their fault. Maybe we haven't done the best job of sort of getting them to take it serious. I'm not sure, but without a doubt, there's some places around the world that they're calling it a second wave, but the curve is a straight line up. It never even had a bit of a dip, and here we are, always finding out more evidence about the characteristics of the virus, and doctors now warning it might cause this, that, and the other. So yeah.
And just on that, I actually have friends both in the UK and in the US, friends that have both lost people in this outbreak, right? And these were not old people, these were people in their 40s and 50s. And the point I want to underscore is that anybody who thinks this is just scaremongering and it's not serious, wake up. This is a dangerous situation. This is a dangerous bug. And I just want people to understand that we have to be serious about it.
Absolutely. And there's no doubt that they are going to blame all the economic problems and that whatever downfalls happen on this. We're not trying to say that that's not the case, but the people out there in the comments that are still saying that, the virus doesn't even exist and that sort of thing, okay, you've got to get with it a little bit. So, yeah. Okay, let's dive into these slides, Martin. You've got 13 slides for the top 10, which I love.
I put quotes around the 10,
You
a
did.
bit of inflation and pressure coming in. Look, the first one is just on Melbourne. Obviously, everybody knows we've got a lockdown now, but it's just worth looking at the latest data that shows the real spike in Melbourne and Victoria relative to the other states. And that's today's data, right? So that's the latest. And the other point to make is that the new rolling cases is up. This is a national picture. But more importantly, the community spread is up. And that's the difference this time, because if you look at the first time around, most of it was actually imported through, international travelers returning and those sorts of things. This is different. This is actually now in the community, which is why it's going to be so much harder to stamp it out.
Yeah, and that's there's probably even more granular charts if you go onto the COVID websites, and you can see it just so clearly. And that was always the number that I guess we were sort of talking about as well when everyone was coming home and importing these cases, and then we had the community spread from the ships when things didn't go right. And they're starting to see a few, plane loads of people not being checked and this, that, and the other. That is what really worries me now, that there's the community spread. It's still going up. People aren't wearing masks. That it's just not in the Australian culture to wear masks at all still. So I think those things are probably weeks or months away, and it's going to keep spreading until that happens.
Yeah. And the point is, you cannot have an economic recovery until we've got the community disciplined enough to understand that this is a new normal. We have to behave, differently than we had previously. You can't just go back to life as normal, because it's got to be a new normal if we are actually not to have raging community spread a la the UK or the US. And, you can throw money at trying to get the economy to bounce back, but it won't bounce back until such time as the health issues are under control.
Yeah, and the countries that went hard early, like New Zealand, and that's, I guess, what I was advocating for. You shut everything down, just do it for 4 weeks. And if we had done that, no point saying that now because we can't change history. But I just fear that we're sort of having these waves where less people take it seriously each time, more people get frustrated, more businesses go under. That's the thing that you're kind of dragging this out. Yeah.
Yeah, and the data from both consumer land and business land, which we'll touch on shortly, shows that businesses, particularly small businesses, who perhaps were hoping that they could begin to emerge from the shutdowns in Victoria and Melbourne in particular, now are down again for another 6 weeks. Many of them will never survive, and that's the problem we've got, because we've not taken it seriously enough early enough to be able to really clamp down on it. And community spread is diabolically difficult to deal with.
Yes. Okay. So we've got the super slide here. We've seen a pretty steady trend. If you have a look at this middle chart here, it's not like we just saw a spike and it's sort of come down. We've seen just a gradual increase in the value of all these applications and people withdrawing from their super.
Yeah, and remember that there's a 10K in the last financial year and another 10K in this financial year. So you've got to expect that chart to continue to rise. And interestingly, the surveys that I run suggest that some people who grabbed that super weren't necessarily in direct strife relating to COVID. And I noticed that the ATO is now putting out dire warnings about people who actually pulled money out when they shouldn't have. They might be tapped on the shoulder in some way, and they might be charged, additional tax on it or worse, right? And they've also warned that businesses who actually went for some of those loans may actually incur tax implications. So my point is, there are consequences for some of the things that have gone on. Throwing the money around, throwing it out is maybe good, but there are consequences that people haven't yet fully understood. And the ATO is beginning to get quite active with regard to what's happening. The other point, of course, is that the superannuation withdrawals are not equally dispersed. It's quite a lot of younger people who are actually pulling money out. And if you think about the cumulative effect of investing in super, it's the early years in super, because of compounding, that actually gives you the best returns. So essentially, people who are pulling money out need to recognize the fact that they may need to do that because of the immediate situation, but the long-term consequences in terms of superannuation is actually pretty dire.
Yeah, no, I definitely agree with all that. I'm not sure what's the policing around this, Martin. Those people that have withdrawn that weren't in any financial distress, have they lied on the forms, or how are they even allowed to in the first place?
Well, it's a good question. So the ATO had sort of processes, and we wonder whether those processes were as good or as up to date as perhaps they should have been. But it looks to me as part of the tax return processes, particularly, they'll be looking at this in some detail. So I wouldn't be surprised to find some people suddenly find that they're being tapped on the shoulder. Excuse me, can you just justify why it is you you did that, right? So, for example, if your income hasn't really dropped when you do your tax return, that's going to be pretty obvious, isn't it?
And I do understand the people out there that are saying, well, I don't think my super is going to be there. Look at the unfunded pensions all around the world. I'm taking that out to invest in. Maybe they're investing in their own stocks, like we've seen with all these Robin Hooders. Maybe it's the gold and silver or the cryptos, and maybe that even outperforms stocks over the next decade. We don't know, but these are interesting things that are going to be in the headlines in the next few weeks and months.
Yeah, that's right. And, it's quite clear to me that a number of people did take money out and are either saving for a deposit for a house, or indeed, as you say, have gone into the stock markets. And, the exponential increase in the number of new stock trading accounts, both here and around the world, indicates that people have actually piled in and are riding the current wave higher. Of course, the question is, how much higher will it go and what will happen? And I still think the stock market's in for a bath later in the year.
I might disagree with you on that one, Martin, but we'll get to the reasons why later on. But mortgage stress has risen sharply after a little bit of a dip just last month, was it? And you've got the projections in blue.
Yeah, so that's right. So last month it went backwards, and that was because we started to see the JobKeeper support, and a few people started going back to work. But I've got, I think, what I call now structural unemployment starting to haunt the numbers. So what I mean by that is, initially, a lot of the people who were actually out of work were, casuals, part-timers, fragmented jobs. But now we're seeing corporate redundancies flowing through, because the corporate area are beginning to sort of right-size their businesses based on what they think this is going to look like. So, for example, consulting firms have actually laid off hundreds and hundreds of staff in a number of different businesses. We're seeing the financial sector also laying staff off. permanently now. These are permanent redundancies, not temporary ones. And my suspicion is that we're going to see more and more structural unemployment. The difficulty is that a lot of those people were on much, much higher incomes than the JobKeeper support level. So, or even job seeker. So a lot of these people are suddenly finding themselves in financial difficulty for the first time ever. And that's one of the reasons why we're seeing a rotation in the mortgage stress. And it's more affluently aligned than previously. And that's why we're also projecting higher rates ahead.
Yeah, and I think it's probably worth noting that mortgage rate, we had those basis points where the RBA cut really aggressively, and that, well, it doesn't look like it's made a difference on that chart. Imagine how bad it would be if we didn't have that. But now we don't really have a lot, and the banks aren't, we've seen some 1.99% mortgage rates out there, but the banks really don't want to go a lot lower, and people are freezing their mortgages, so the banks have got all their own issues. And that example you gave, I mean, I'm sure everyone's got their own stories, but just the other day we had a friend who's worked at Armaguard for 20 odd years, and they went to work on Monday and they were home at lunchtime on Monday, made redundant, after 20 years, and these sort of are the stories that we are hearing.
Yeah, and it is redundancy. It's not temporary layoffs, right? It's not a JobKeeper story. It's permanent resizing of the business. And unfortunately, if you tot up all of the thousands and thousands of jobs that have been announced, as well as the ones, of course, that haven't been announced, this is a really serious wave. And that's why my expectation is that the unemployment rate is going to be significantly higher than the official rate, which is 7.1 at the moment, right? And we could be up towards 15%. And in fact, you could argue that if you take the real rate, in other words, if you count the job keeper differently and you count the informal unemployed, the ones who've stopped looking, we're already up to 15, 16, 17%. And that's a huge number. That's way higher than in the last major recession that we had. And I do think unemployment is the key. It's the key to business confidence. It's the key to consumer confidence. It's the key to the mortgage market and everything else, and home prices too. And with that level of unemployment, I can't see how we're going to get out of this without a considerable downturn.
Yeah, and I'm not even too worried about what the official number is. John Williams does the shadow stats over in the US. I think maybe we need to start doing that, Martin. DFA doing the Australian shadow stats as well. But the Bureau of Labour Statistics came out and said, don't take too much notice of these month-to-month numbers anymore. They shouldn't be considered as accurate, or decisions made off of them, or something to that effect. And it's just like, as soon as things start going bad, it's Apple stop reporting the number of phones they're selling. Banks that have to stop reporting their derivatives exposure or their stress levels. It's just all these, okay, things are bad. We're not reporting property prices. It's just all the sort of, let's not talk about it because it's bad.
And remember, the RBA in its FOI that was released 3 or 4 weeks ago was discussing whether they should actually freeze the property market and basically encourage the property indice publishers to stop publishing.
No, exactly. So you've got the rental stress postcodes here.
I just wanted to make the point that I'm tracking rental stress as well. Now, this is on a cash flow basis, again, just like mortgage stress. 1.8 million renters in difficulty. But the key point is Melbourne 3000, right, is actually the highest in terms of the number of people in rental stress in the entire country. And that, of course, is now right in the middle of the closure. And in fact, if you look at mortgage stress, if you look at rental stress, and then the second we'll look at property investor stress as well, it's all being centered down in Victoria at the moment. There's a huge thing going on. So I think that the Victorian property market is probably going to be the bellwether for what's going to happen elsewhere. And a lot of it's centered on the center of town.
Yeah, but some of those percentages in other suburbs are crazy high, really, aren't they? 80%.
Yeah, and that is the point. So we've got a lot of people who are renting. Now, in some cases, what they're doing is actually shifting to cheaper places. So, rentals are down. We'll show you a chart on that shortly. But the other point is that not all landlords are being nice when it comes to accommodating the pressures that some of people have because of their incomes are much lower than they were. And particularly some of the landlords who are controlled and managed by some of the real estate agency groups, they're actually being very aggressive and sort of saying to people, you've got to pay, and we'll give you a little holiday, but it's not a holiday in a real sense. We're just deferring payment. So whenever this stops, we're going to see another reason why there's going to be a cliff ahead, unfortunately. So I think the rental sector is another leading indicator of more trouble ahead.
Yeah, and again, those different stories of some people being told they've got to access their super to pay their rent or their mortgage. So it's all very idealistic to say sit down with your bank and your landlord and work things out. But when there's humans involved in the real world and these numbers and there's financial stress, even just mental health, people are stressed at the moment. Unfortunately, these things come into play.
Yeah, and it all comes together, and there are many people, who have little income. A lot of people in the centre of Melbourne there were actually students, so they're people with now no support from the government at the moment as well. So that's another factor. So this is really messy, really complicated, and I think it's right to draw the connections between people's well-being and what's going on. This is a big deal.
Okay, so you've got the property investor stress estate numbers here as well.
Yeah, so I'm quite proud of this. This is the first time that I've published property investor data. So it's complicated because you could live in one postcode but have a investment property in another postcode, right? So what I've done here is not looked at the property investment properties themselves, although that actually is listed in the first column. So we know how many properties are for rent. About 3.2 million properties are renting properties across Australia. But now I'm looking at the rental property owners and where they live, right? And what proportion of them are actually experiencing financial flow stress. So about 25% of property investors are struggling now because rentals have stopped or are actually way down, or they've got vacant properties. There's more than 1 million vacant properties across Australia at the moment. This is a huge deal. And so that's not surprising to see then that a lot of property investors are now saying, I can't make this work anymore. There's no capital growth ahead. The rentals are way down. The costs of managing the investment property are very high. There are new rules coming in a number of different locations. For example, in New South Wales, there are extra obligations now on landlords as well. So I think this is the end of the property investor wave that we've seen running for at least 15 to 20 years. I think this is really structural, and I wouldn't be surprised to see way more property investors, about 12 or 13% of them, saying they're likely to sell. They'll be trying to sell before prices fall further. I think this is the most significant change, if you like, in the market. And it's triggered partly by COVID, but it's also triggered partly by the structural cycle that we were in before.
Yeah, no, it's beautiful data. And I think going forward, Martin, I think this would be really good visually in some pie charts and percentages so people understand how this is changing as well, which we can tinker with. But what I would comment on is the numbers. So 35% investors stressed in New South Wales. When we were talking before about Victoria, where this is looking like Melbourne, where it's the worst, it's only 25%. So what do you see there with those differences?
Yeah, so the big difference is that properties were more expensive in New South Wales, and particularly in and around Sydney, relative to Victoria. So there's a bigger mortgage to start with, and the drops in rents have been more significant in and around New South Wales initially, although Melbourne's now catching up. So that's some of and there's more spare property in and around the centre of Sydney. We're also seeing, of course, quite a few ex-Airbnb properties now coming onto the more permanent markets. A lot of people were doing very well with Airbnb because they could charge much more for their short-term lets. That's gone away. So yeah, unfortunately, the story in New South Wales is not great. But what's interesting is if you look at the postcodes, and I haven't put the postcodes at this time, we can do that perhaps next time. Some of the postcodes in and around Victoria, there is the highest levels of rental stress we've seen, but there's also the highest level of investor stress as well. And a lot of people living in 3,000 are property investors, and they're in difficulty too. So whichever way you look at it, mortgage stress, rental stress, property investor stress, there are hotspots now, and those are common hotspots. And frankly, Victoria 3,000 and the immediate postcodes around there is a real hotspot. Another one is around 2,000 and just around the centre of Sydney as well. These are big moves and big, very significant issues.
And ACT's almost 35% as well. I would have definitely thought with the politicians of the government jobs, we wouldn't have seen high stress there. So what's the reasoning there?
Well, again, you've got high prices relative to a lot of incomes, and there are a lot of people who are on relatively low incomes, particularly in some of the support roles.
Okay.
I'm thinking of cafes and hospitality and those sorts of things. A lot of them were renting, and you've also got quite a lot of temporary people into there and out again. So that's all part of the story. But yeah, it is quite big. The absolute numbers, of course, are very small, but those percentages, I think, are quite telling.
Okay. We've seen the loan deferrals extended again. I don't know. Well, we've even got Commonwealth Bank talking about stopping dividends now. So we're seeing the bank's cash flows really put on ice.
Yeah, and it's just worth reflecting. This is the ABA data on the left-hand side there. So, 500,000, give or take, mortgages are actually now in deferral, plus some business loans. And what I thought was interesting was what the analysts were saying about this. So Moody's basically said that the decision to extend the policy was not necessarily good. It highlights the large number of borrowers that have been impacted by the current economic disruption, significantly raising the risk for Australian bank asset quality. And UBS, Jonathan Mott, in fact, said that this is an extending and pretending, I love that phrase, extending and pretending that the loans were good, right? So APRA's changed the rules. So basically allowed them to appear to be good loans for a longer period, up to 10 months. But, quote, we believe it's difficult to argue that any loan that's not met scheduled repayments for 10 months has not seen a significant increase in credit risk and should be treated as a non-performing loan. And the point is this 6-month to 10-month extension, the 4 months, one of the things that APRA has said is that banks need to have conversations with individual borrowers, and if it's appropriate, extend the holiday. But if people are in more serious difficulty, then they've got to have other conversations, which include perhaps asking them to restructure the loan or asking them whether they should consider selling. So my expectation is we could well see in that 4-month window between, October, November, December, January, quite a rush of people realizing that they can't go on forever in this new mode where effectively incomes are under significant pressure or they've disappeared completely. They can't service those mortgages. And so there'll be some pressure being applied by the banks for them to sell. So expect more properties to come on the market under forced sale. And we're already seeing a risk of a rise in the mortgagee sales even now. So I think we're going to see, this is a really big deal. And, I know that everybody wants it to be over and come back to normal. But what this data is suggesting is it's going to be very unlikely. And they're just pushing away this critical decision. And at some point, the banks will have to start recognizing non-performing loans. When they do that, they have a capital hit. They're going to have to raise more capital. And it also makes it more difficult for them to be able to manage their businesses effectively. And they're all powering up their their support services. CBA said they've got more people now working on the front line to try and help borrowers. This is a big deal.
Yeah, I think the thing that I want people to understand is this is another example to me of the sort of siloed nature of these different departments and kicking the can down the road, and everyone wants it to get better. But the reality is that if you start to have these conversations now and start to see people that can't pay, it's very different to saying, APRA saying you can count these as performing loans. They're as good as gold, and I'm not sure how much that affects the the ratings agencies and mortgage-backed security market, which isn't that big in Australia compared to elsewhere. But all these things where we're just saying this is all fine. Again, under the surface, unemployment, small businesses, a lot of these numbers are starting to get really significant, and we're just going to hit this peak where are they going to just kick it down the road again? But whenever they realise what is actually going on and how many are non-performing, because of the leveraged nature of what's going on, the derivatives exposure of the banks, these things can get really nasty. And you can look and go, oh, we've got a mark to market now. Prices are down 10%, 15%. We've got 20% of people that can't pay their mortgage. All those things are enough to just make you like a liquid or insolvent straight away.
Well, the APRA has allowed the banks not to mark to market.
That's the point I was getting to. Yeah, exactly.
Yeah, so at the moment, they can recognise all of these delayed repayments as good loans, and they don't have to mark to market their portfolios, so they can take the value of the property as it was then, despite the fact that property prices have started to slide and are moving, in some cases, down quite smartly. That means that we're getting further and further away from reality, right? But at some point, unless there's going to be a V-shaped recovery, which I can't see, we're going to have to they have to come to the party and recognize that we're in the new world. And the banks are going to need more capital, because if they start putting loans into the unperforming bucket, they immediately need to hold much more capital than they do currently. And remember that the major banks have these internal models that they use, right, to be able to manage the capital. And now APRA has basically said, well, you don't have to worry even if those models are not behaving like you expected them to. Don't worry at the moment, just run with it, right? So on every front, APRA is basically giving the banks more and more leeway to muddle through. The question is that really a sensible policy, or is it just pushing this further and further out and creating a bigger and bigger problem for later? My own view is it's very unlikely how this is going to cure itself. And the sooner that people start waking up to the fact that if they've got a significant issue with their mortgage, just kicking the repayments off a bit is not going to fundamentally solve the issue for them. And by the way, another little sidebar is the personal credit numbers went up dramatically. So a lot of people are now tapping into personal loans to try and actually help get through, right? As well as using Afterpay and those other buy now, pay later things too. So people are sort of hocking themselves even higher to try and get through this. But structurally, this looks pretty serious.
And that's when even the stress tests that the Fed ran the other day in the US, and I don't think they went well, because they've made all these different changes in the US, like we've seen with the Volcker rules and that. It's making things systemically more dangerous. And the only way out of it is, again, the RBA going to probably end up printing a heap of money and buying a lot of these mortgage-backed securities, or capitalizing these banks. There's going to be huge amounts of money printing here, again, if it continues on the path we're on.
Well, they'll probably have to buy some bad loans. And remember that before COVID, the delinquency rates were actually rising. So the default rates were rising already. So I expect to see the default rates rising. And everybody, all the analysts are now saying default rates will be significantly higher ahead. So I think we're on a bit of a precipice here. And, whilst they would like to be able to just push it into next year and beyond the election, I think that we're going to have to see later in the year and into next year some of these issues coming home. And it will not be pretty.
Okay. Lending flows and overseas demand. We had a bit of an interesting uptick in Victoria, Martin, but obviously we'd expect that to fall away now.
Yeah, and on the right-hand side, that's the NAB data. So that's basically just making the point that compared with 2 or 3 years ago, the demand from overseas buyers has really dropped. And there's a little bit of noise in it, but it's pretty small. And that's true for both established property and also for new property. So foreign buyers, you can write them off. There's almost no activity these days. And the other point is the data from the ABS came out yesterday on lending flows, and that was a 9% drop relative to previously. And it's the biggest fall since the records began, or 2002 or something, right? So this is a pretty remarkable change. And the thing that's going on here is there's a big shift. So very high levels of refinancing from one bank to another bank to try and get a cheaper rate. A lot of people are going into fixed rates at the moment, a very big spike there. But overall, the volume of new loans has fallen through the floor. Now, people are saying, well, that's a one-off thing, it'll bounce back. Well, maybe it will, or maybe this is actually, the signal that the lending cycle has come to a bit of a shudder too, because if unemployment is a lot higher than it was and banks have been hunkering down with their lending standards, they will be less willing to lend than previously. And okay, they're going to extend loans repayments, and that means that some people will have bigger loans. But net, this looks like a significant tweak in the market. And remember, I keep saying it's the rate of change of credit growth that actually drives home prices. Well, guess what? A significant drop in credit would suggest to me that's going to translate into property price falls later.
And that number, did I see correctly, it was 18% month over month in New South Wales, or like staggering numbers.
Yeah, so there were big falls in the Victoria and New South Wales. Both had significant drops. And the property investors way down, owner-occupiers a little down, and a lot of refinancing. So a lot of refinancing went on, going to new loans and to fixed rate loans. But yeah, this does not look good.
All right, so the property spruiker in chief. We've had Scott Morrison talk about property in a lot of his speeches before, but there's a few interesting notes you've got here, Martin.
Yeah, so this was actually in a press conference yesterday when he was asked specifically about the huge plunge, the double-digit plunge in credit growth, right? And so, do you have any concerns? They asked about the housing market and what can the government do to avoid a housing price collapse? So, first observation, the question itself predicates the idea that house price collapse is bad, right? I would argue that we've been in this stratospheric level of house prices for so long that we're just acclimatized to it. But actually, we need an adjustment to get back to more normal levels. That's the first point. But what he said was demand always outstrips supply. Not true. There's 1.2 million vacant properties across Australia at the moment. So that's wrong. But anyway, so he says it's demand driven. And he basically said it isn't driven by speculative investor bubbles or speculative credit. Well, disagree. I mean, the investment sector has driven the market, and now the investment sector is falling away. I showed that earlier on. So he's wrong on that point, in my view. The structural position of the housing market would tell a far more stronger tale in terms of their resilience compared with other markets. Well, except that we've got the highest debt to income ratios, almost everybody. We've got the highest amount of debt in our banking system supporting mortgages than anywhere in the world. And now we've got unemployment rising, and we've got mortgage stress rising, and we've got delinquencies rising. I have to say, his position here is just untenable. It doesn't actually take account of the facts on the ground, and I just find it remarkable. But he's very much linked, of course, to construction and wanting to support construction and want to talk the market up. But at some point, reality has to dawn, because at the moment, what he's saying and what the data is saying is not the same.
Yeah, and I tweeted out this morning that article that AFR wrote about how I think he said further on, or I'm not sure if they're paraphrasing, but don't panic was basically what he said. And the old saying, when someone says don't panic, it's time to panic. There's so much riding on the property market. We know a lot of the politicians have got at least 2 properties. It is overvalued. They don't want to let it come down. They've started the 5% down. Now there's the dual grants you can get. So in Tasmania and Western Australia, you can get up to $45,000 or $50,000 to build a house now. They've thrown a lot at it already, and I just fear what's going to be left to thrown at it. But at the end of the day, people still need jobs, and they can't save everyone. And the government's next move looks like they're going to try and pick industries to support, and there's going to be a lot of unhappy people. That's a political decision when you start picking winners and losers. In America, the Fed have started picking corporate bonds, so corporate winners and losers. I just think this is where we're going to see more civil unrest. People are really unhappy. And they're just in these ivory towers where they just have no idea the percentages that we're seeing. In America, I read that 52% of restaurants on Yelp, the ratings app, have closed forever. 52%. These are really big numbers. 30% missed their mortgage payments last month. So I think they're kind of pretending that things aren't that bad. But under there, yeah.
Yeah, and it's worth just reflecting briefly on what happened in the UK. So they basically announced some further support mechanisms in the UK, and they've reduced stamp duty for transactions up to £500,000, right, whereas previously it was a lot lower. They've also they're trying to give £10 a head for people to go and eat out, to try and support the cafes and restaurants, and they basically made the point that their equivalent of JobKeeper they're not going to continue with, because they don't think it's appropriate to continue to support businesses that should be allowed to fail. That's basically what they said, right? And that's the real dilemma, right? So for how long do you go on throwing government money at businesses that actually are zombie businesses and will never be able to recover? Is it fair on the business? Is it fair on the business owner, as well as the taxpayer? Because, you can go on throwing money, but the more money you throw at those types of businesses, the less money you have to invest on really good, productive next generation businesses and new sectors and, innovation. And my bugbear is that we're trying to sort of prop up the old version of the economy, rather than using this as an opportunity to create the foundations for the next economy, which will have some different parameters to it. That level of innovation and thinking is just nowhere to be seen. I'm very concerned about that, because you're right. They're going to pick winners and losers, but unfortunately, they're going to pick the old winners who actually were already looking as though they were going to turn into losers in their own right. So this is a huge, huge issue, and unfortunately, the policy is just completely shot.
I completely agree. And I even think the conversation's probably further progressed in other countries around direct payments to individuals. China and the US, they're working on these digital central bank currencies where they want to be able to give people money directly. We're nowhere near ready to do that in Australia and the RBA. Maybe we have some more stimulus checks, but we've already seen the price of food go up. So they're trying to walk this fine line between universal basic income and inflation versus just giving these business owners money who are not using it for the right reasons, keeping zombie businesses alive. At the end of the day, I'd be throwing everything at innovation and getting people to start businesses, move the economy forward, as you say. But with our current tax rates and their thinking, we are just getting more and more uncompetitive, by the day.
Well, I agree. And remember that JobKeeper was originally targeting, 6 million people? And it's coming around just around 3 million, a bit above or a bit below, depending on which you look at. But of course, a lot of businesses who signed up for it didn't actually take it. And the reason they didn't take it was because they could not make it work because of the cash flow issues that they had. So in a way, even the support mechanisms which were designed and put in place were actually rather less effective than were originally planned. And that wasn't because businesses are actually performing better, it's because they just couldn't jump through the hurdles. And the other point, of course, is the 23rd of July will be the next sort of mini budget. And that's when we're going to get some disclosure from the government as to what they're thinking beyond September, because you can't allow all of these support mechanisms to just drop off at the end of September, or we'll have a huge crunch in terms of unemployment. But how you taper it and shape it and where you put your dollars is a hugely complex and difficult question. I don't think they're going to make the right decisions, unfortunately, and I think that will be to our detriment in the next 12 to 18 months.
And I think, again, other countries have started to even think about the modern monetary theory, or call it whatever you like, but if we have all this slack that the government needs to pick up, I see that as a sort of a net zero. If people have lost their jobs and you've told them they can't work, keep supporting them, whereas they're worried about this budget deficit and the debt, whereas I think it's time to have these conversations about how much debt there are in all these countries. It's either going to be inflated away, defaulted on, or a jubilee like Steve Keen talks about, whereas we're just still really worried about having like a balanced budget, and I just think that's going to do more harm. And we're seeing some really smart economists start to talk about modern monetary theory these days.
Right, I don't know whether you've seen, but The Deficit Myth by Stephanie Kelton is actually a really good book. I do recommend that people get hold and read it, or read the bits online. This is actually probably one of the best exposition of what MMT is really about, which basically, in a nutshell, says if you can borrow at very cheap rates and you can invest the money appropriately in growth projects that actually makes a better return over time, you can grow your economy and therefore can actually manage this and actually get high levels of employment and better levels of prosperity into the economy. That's basically in a nutshell, right? And I think that's right. But this is something which is so far off from where the government is at the moment that I just think it's like a different universe.
Yeah, completely agree. All right, so rentals down, retail vacancies up. Some of these streets that people will recognise, Bridge Street, Chapel Street, over 20% vacancies now.
Yeah, and this is horrendous, right? So we've seen the destruction of the retail strip, and this is some data from Melbourne that came out in the AFR yesterday. And some of those are very well known places to shop, but they're huge vacancy rates. And then on the other side, units, rentals are also down as well. So if you look at the quarterly change, which is the bars, you can see that in Hobart it dropped, more than 8% in a quarter. These are remarkable movements. And the other point to make is there that the median rental price is also, obviously down. So this is why the rental sector is now beginning to signal real issues. And then the retail sector that we discussed earlier, the fact that many people are now leaving their lockups, in the retail strips. And frankly, wherever you go, you now see to let signs and vacant signs in the the commercial sector. So these are the leading indicators to me of just how serious an economic situation we face. And this is a national situation. It isn't just in the main centres. I mean, I don't know what it's like down in Tassie there, but certainly from this data that we'd suggest that there's going to be high levels of vacancies and more businesses going to the wall.
Well, I know for sure there's a lot of families that own a lot of those properties in the CBDs, in the Tasmanian cities and towns. And it's the two tier where it's the business owners are sort of the middle class that are now making their way down to the lower class. And the upper class that own these are saying, we don't mind if they're vacant. We'd rather do that than put rents down, and they all do this together because it's the game of Monopoly, quite literally.
Yep.
And so they're
Yep.
happy for them to be vacant for a year or 2 years until wealthy overseas investors come in, or whatever it is. Because if they all keep them high, they've got enough money to see it out, whereas the business owners don't have enough money to keep paying rent. So again, that is something that I've literally heard these stories as you've just pointed that out.
Yeah, and the ABC did a really interesting piece where they basically tracked individuals and the connections between the person who was paying the rent, the business person who was actually receiving the rent, and the owner of the business premises that the business was using. So all these connections, right? And that's the point. You got to see this not as just silos of activity. This is an integrated, connected set of systems, right? And of course, when things are going wrong in so many areas, the systemic feedback loops that you get are so powerful and so difficult to deal with. And that's why even just throwing more money at the problem probably won't solve it.
Yeah, I used an analogy in an interview I was on yesterday, Martin, of think of the economy as a sausage machine, and you put in all your different things, and the government at the moment, they keep pouring money in, but the way that we've got, tax and the incentives and the handouts set up to go to corporates or go through the banks, they're sitting there looking at the real economy and the average Joes and going, oh, why isn't this money getting there? And then the stock market's going up, and all the money's going into the financial sector and the 1% of that sausage machine, and they can't work out why that's happening.
Well, it actually gets you to the question of, well, what is society for, right? Is society for just making the 1% richer? Or is actually society for maximizing the well-being of the greatest number of people, right? Now, I would say the latter, but that requires a whole different way of thinking about the way economies work and where you put your money, and even things like universal income, those sorts of things. There is a fundamental economic discussion to be had here about what is right for the future, because I have to say what we've done for the last 20 to 30 years has not served us well as a country, as an economy, and for most people, while the 1% are doing well, everybody else is effectively picking up the pieces.
Yeah, and the people that are maybe demonstrating or getting angry or getting hurt by this, they're not the sort of people that have thought about this as a philosophical thing before, but now that it's right under their nose and it's affecting them. And again, another point that came up in this interview yesterday was everything goes out the window once your kids are hungry or something like that happens and you're in real financial distress. And so hopefully things, don't get that bad in Australia, but that's what we're starting to see in the US and other countries. Lebanon had 50% devaluation of their currency in 1 month.
Yep.
Crazy stuff happening worldwide because of what is going on in the economies.
And the point I want to make is that these are decisions that are taken formally or informally by our leaders, right? They have some basic assumptions about the way the economy works and the way it should work. But the fact is, they are assumptions. They are basically based on a particular way of thinking about the world. And in fact, if you shift your thinking and say, well, hang on, maybe there's a better way, an alternative way, there is an opportunity to actually then craft a rather different path and a different set of outcomes. Those are the sorts of conversations I think from a policy perspective we should be having. But unfortunately, no, we're not. We're down in the weeds and we're sort of fixing the construction sector there and we're fixing this over here, right? There is no joined up thinking, unfortunately. And that, for me, is the real problem, not just in Australia, but around the world. And yet there is an opportunity, if we did but see it, to actually start taking a different path.
Yes. All right. So obviously confidence is trending back down after that sharp V-shaped bounce.
Yeah, and just to say, this is the latest from Morgan. So confidence came down, and that was basically because of the, I think, Victoria. Business confidence is also looking pretty shoddy, and Frank is coming down again. The latest surveys that I've got. So confidence, and the reason confidence is important is because you're going to actually make your spending decisions differently if you're confident versus if you're not confident. If you're a business and you're not confident about your future, you're not going to invest. If you're a consumer and you are not confident about where your income's coming from, you're not going to spend. You're going to put it in the bank if you've got money, and you're going to be much more cautious. And these confidence metrics tend to have a very long shadow over economic performance, right? So this is something to watch, not just over the next 2 to 3 weeks, but over the next 1 to 2 years. Because essentially, if you come back to what's driving the economy, a lot of it is obviously consumption. Well, if consumption continues to be weak on the business and consumer side, then our economy is frankly being propped up by just government spending. But how long will that go on for? And is that going to actually create sufficient activity to be able to actually create the wealth that the country needs? Probably not.
Yeah, one of the things I always talk about is how sentiment drives all markets, and it's very obvious in something like the cryptocurrency space because they're hard to value, and it's basically sentiment that drives everything. Now, if you think about that in the property market or the economy, look at those stats before where 35% of investors in New South Wales are now underwater or in mortgage stress. You go to the barbecue, there's 10 friends there that were all previously in profit and all talking about their property portfolios. Now you've got 3 or 4 of them that are underwater, and then the other, maybe 1 or 2 of those 10, they start to worry that they could be next. And the whole sentiment around this only ever goes up that we've had for 20, 30, 40 years. The sentiment can change really quickly. They're the sort of things that are now coming into play.
Yeah, no, that's absolutely right. And there's a lot of play, and that's one of the reasons why my scenarios are quite interesting, because I've updated my scenarios, and I still think that there is a very small chance of property prices rising in the next 2 years. But frankly, it's almost certain now property prices are going to fall. And now it's a question of how far they fall, and that's a function of what's happening with the virus, what's happening with the economics, how much government support is going to be thrown in, as we've discussed, right? And I guess there's an argument to say, well, if a lot of government money is thrown into the system, is that then going to lead to asset price inflation? Is that going to keep prices high, home prices high? Is it going to keep, other stock market prices high? There's a theory that says that's the way it's going to be, or is it actually all going to come unglued? And that's the difficult part. Nobody can tell. I don't believe that anybody can make accurate predictions over the next 2 to 3 years, right? There are too many variables, too many uncertainties, which is why I use scenarios.
Yeah, I mean, if I was just to disagree or play devil's advocate, I'd probably say, look at how aggressive they've gone already. The Fed's done 3 or 4 trillion. The government have spent these record deficits in the trillions as well. If I look into the future, Steve Keen and I did an interview called Turning Japanese a year or 2 ago, and that's where everyone's going. And I think that the Fed don't want a stock market crash. I think they're going to end up owning 80% of the ETFs if that's what they have to do, the same as Japan. So it wouldn't surprise me for the stock market to stay up. It's a bit harder to keep printing money to keep housing prices elevated, but maybe Australia is so obsessed with property, we just put in tax break, bonuses, bigger handouts, throw everything at it to keep it propped up. Maybe they freeze the market like they were sort of floating. So I would say, don't discount anything in this parallel universe that we live in at the moment. And it's crazy, but it's very different to the real economy, what's happening.
Yeah, that's the point. And very many uncertainties. And so my honest view is anybody who claims to know for sure what's going to happen over the next 18 months to 2 years, don't believe them. There are too many variables, too many uncertainties, too many things that are unpredictable. And we could overlay China and a bunch of other things over the top as well. So yes, I think be cautious, be careful. And what I say to people is, in the current environment, just be very cautious and careful about the decisions that you take, because there are so many uncertainties, and you cannot bank on future property price acceleration, nor can you necessarily bank on stock price acceleration. But there are some scenarios where you could see it happening, but there are also downside scenarios too. So the risks are pretty high.
And Martin, maybe just a little bit off topic as we wrap up here. I know in the past you haven't been that big of an advocate of gold or Bitcoin, really. As we're seeing this monetary policy around the world, trillions being printed, the Lebanon example, those people that held Bitcoin didn't lose 50% of their wealth this month. Are you starting to maybe come around to it or understand it or think it's going to be more applicable in more countries? Or
I'm still not convinced about gold, for the reason that I still think that there's going to be a deflationary force rather than an inflationary force. But that's still my position. With regard to some of the digital alternatives, as I explore them more and understand them more, there is, I think, a conversation to be had there. I'm not a raging bull with regard to cryptos, but if you understand the future evolution of economies and how digital is going to play in, and I did a conversation recently about Ethereum with Caroline Bowler from BBC Markets, and the point there is this is not just about holding a crypto as a sort of an investment. It's actually understanding how it's going to fundamentally impact the plumbing of the whole financial system, right? And I think if you start thinking like that about digital and the various cryptos that are out there, you have a different lens through which to see what that could be, and therefore there is potential value growth over the long term. It's just very uncertain and unpredictable, and I always say to people, if you go into crypto, just bear in mind that it could go up, could go down, could go sideways, nobody knows. But if you understand and go on that basis, then in the current environment, I think the future will be more digital rather than less digital.
Yeah, and I think what I want people to understand is that investing in the Bitcoins or Ethereums, as you say, is a lot of unknowns and volatilities, but investing in the whole stablecoin space, it doesn't really come with that volatility. And I've got this theory about how, just as you said then, all the payment rails and the banks and now central banks and governments are talking about issuing their currencies. We've got the Fed opening up these swap lines with other countries because the financial plumbing is broken. And you've heard this US dollar milkshake theory. Well, I call mine the digital thickshake theory, because all these stable coins, and as long as you or I have got a phone, we can send money to each other and have digital stable coins. And that is just going to completely replace the plumbing of the traditional financial system. And it's going to make that old system look like a thickshake where people can't get money from one place to another and it's slow and horrible. So when these young people now can say, my bank, I'm a little bit uncertain about my bank in Europe, or I can just use this app and I can get a 5, 6, 7% annual yield now versus negative interest rates, for example, I just see that these are all the reasons why we're going to continue to capture market share off the traditional world, where governments are saying, no, you have to use our money that we're printing trillions of, and other people are saying, well, no, we are going to use this money, which you can't debase or force negative interest rates on us, those kind of conversations.
Yeah, and the point is, this is an evolution that's early in its life, isn't it? Right?
Yes.
People should understand that the digital world is moving fast and it's accelerating quickly, but it's still very early. And there are a number of different futures that can be played out in down the track. But yeah, so I believe fundamentally that digital has a foundational place to play in the future economy. The shape of that, not sure about, but probably therefore more bullish with regard to the digital future rather than holding gold, personally.
And do you want to mention a live?
Yeah, I just will mention next. In fact, the date's wrong. I realise on the slide. It's actually next Tuesday, the 14th of July. I've got Veronica Morgan on my DFA live stream at 8 p.m. on Sydney in Sydney. Yep. That is significant because a lot of people have asked me, can you get somebody who's more bullish on property than a lot of the people I have on? And Veronica is, I think, a property realist, but she's definitely more positive. She's the lady who does location. So I just thought I'd flag that, and maybe people would be interested in coming to hear what she has to say about property. So that's Tuesday the 14th at 8 p.m. Sydney.
Yeah, and one of the bullish cases I've heard that before the Victoria outbreak happened and Australia had really low COVID numbers, if we were one of the only countries that didn't have COVID and we had really good food, clean air, that could put a huge premium on property. If you had a million millionaires from China trying to move to Sydney and Melbourne, of course that'd force up. But what we've seen lately is friction with China. That's a whole nother video we could go into, Martin, and starting to buy missiles and all this sort of thing. So it all depends on that, but I guess that would be one of the bullish thesis. But if that doesn't happen and we don't have population growth, job growth, then I think it's hard to be bullish property.
Yeah, and look, the fact of the matter is that, and I keep saying you have to go granular if you understand property is different in different locations, different types of property, etc., etc. So I think it'll be a really interesting conversation, and it'll be live, and people can ask questions on the live YouTube chat. So the show is up on DFA if people want to go and have a look at it.
That is an action-packed hour. I hope you guys have really enjoyed that one. Great as always, Martin, and we'll have to catch up again next month.
Good to talk to you. Keep safe.
Thanks, guys. Cheers.